This question tests students' understanding of the fundamental principles of an integrated report. The keyword "correct" indicates that only one statement accurately reflects the International Integrated Reporting Framework. An integrated report is not limited to financial information. Instead, it combines financial and non-financial information to explain how an organization creates, preserves, or erodes value over the short, medium, and long term. Another important principle is balance, meaning the report should present both favorable and unfavorable material information rather than highlighting only successes. Students should carefully identify statements that are too restrictive, e.g., only financial information or only long-term, or that incorrectly describe the reporting format. A. It only contains financial information. Incorrect. An integrated report includes both financial and non-financial information, such as strategy, governance, business model, risks, opportunities, ESG matters, and performance. Therefore, it is not limited to financial information. B. It only focuses on the creation of value over the long term. Incorrect. The integrated reporting framework emphasizes value creation over the short, medium, and long term. Limiting the focus to the long term makes this statement incorrect. C. It should include material matters, both positive and negative. Correct. One of the guiding principles of integrated reporting is balance. An integrated report should disclose all material matters, including both positive achievements and negative issues or challenges, enabling stakeholders to make informed decisions. D. It must be included as a prominent and accessible part of another report. Incorrect. An integrated report may be issued as a standalone report or as part of another report, depending on the organization's reporting approach. It is not mandatory that it be included within another report. Correct answer, C. It should include material matters, both positive and negative. Exam tip. The integrated reporting framework is built on several guiding principles, including strategic focus and future orientation, connectivity of information, stakeholder relationships, materiality, conciseness, reliability, and completeness, balance, consistency, and comparability. A useful memory aid is: integrated reporting tells the complete value creation story, good news and bad news. Remember that an integrated report should present material information in a balanced manner, including both positive and negative matters, making C the correct answer. This question tests students' understanding of changes in accounting estimates, specifically a change in the estimate for bad debts, allowance for doubtful accounts. The key phrase is change in the estimate. Accounting estimates are based on management's best judgment using available information at a particular point in time. As new information becomes available, estimates may need to be revised. Examples include bad debt expense, useful lives of depreciable assets, residual values, warranty obligations, pension assumptions. Under US GAAP and IFRS, a change in accounting estimate is accounted for prospectively, meaning it affects the current period and future periods, if applicable. It is not treated as an error, nor does it require restating prior financial statements. In the case of bad debt estimates, the revised estimate affects only the current period, since it relates to current receivables and the current estimate of uncollectible accounts. Treated as an error. Incorrect. A change in estimate is not an accounting error. An error arises from mistakes such as mathematical errors, misuse of accounting principles, or fraud. Revising an estimate based on new information is a normal accounting practice. B. Handled retroactively. Incorrect. Retroactive treatment is generally required for changes in accounting principles or corrections of prior period errors, not for changes in accounting estimates. Estimates are applied prospectively. C. considered as an extraordinary item. Incorrect. Extraordinary items, which are no longer separately presented under US GAAP, refer to unusual and infrequent events. A revision of bad debt estimates is part of ordinary business operations and is not extraordinary. D. Treated as affecting only the period of the change. Correct. A revised bad debt estimate is recognized in the current period and future periods if applicable. Because the question refers specifically to bad debt estimates, the effect is recognized in the period of the change, making this the best answer among the choices provided. Correct answer, D. Treated as affecting only the period of the change. Examples of accounting estimates include bad debts depreciation, lives residual values, warranty costs, pension assumptions. A useful memory aid is estimates look forward, not backward. Therefore, a change in the estimate for bad debts is recognized prospectively and affects the current period, making D the correct answer. This question tests students' understanding of the equity method of accounting for investments. The key information is: Best Billiard owns 40% of Supreme Table stock. The investment is accounted for using the equity method. Best Billiard's share of Supreme Table's net income is $10,000. The dividends received from Supreme Table are $15,000. Under the equity method, the investment account is increased by the investor's share of the investee's net income and decreased by dividends received, because dividends are treated as a return of investment rather than income. Students should calculate the net effect on the carrying amount of the investment and determine whether it increases or decreases. Step 1. Beginning investment. $300,000. Step 2. Add share of net income. Best Billiard recognizes plus $10,000 because its share of Supreme Table's earnings increases the value of the investment. Running balance $310,000. Step 3. Subtract dividends received. Dividends under the equity method reduce the carrying amount of the investment, minus $15,000. Ending carrying amount $295,000. The investment account has decreased by $5,000 during the year. A decrease in the book value of their investment in Supreme Table. Correct. The investment increases by $10,000 for the investor's share of earnings, but decreases by $15,000 for dividends received, resulting in a net decrease of $5,000. B. An increase in the book value of their investment in Supreme Table. Incorrect. This would be true only if the share of earnings exceeded the dividends received. C. Their investment in Supreme Table at the original cost. Incorrect. Under the equity method, the investment is not kept at historical cost. It is adjusted each period for the investor's share of earnings and dividends received. D. Consolidated financial statements with Supreme Table. Incorrect. Ownership of 40% generally indicates significant influence, not control. Consolidation is normally required only when control exists, generally more than 50% ownership. Correct answer: A. A decrease in the book value of their investment in Supreme Table. For this question, 300,000 plus 10,000 minus 15,000 is equal to 295,000. The investment decreases by $5,000. A useful memory aid is: income increases the investment, dividends decrease the investment. Since the dividends received exceed the share of net income, the carrying amount of the investment decreases, making A the correct answer.